Welcome back. Let's talk about the markets and where we are headed right now. Rakshit Ranjan, the portfolio manager at Marcellus Investment Managers, is now with us on the show. Rakshit, just want to start the first question and this conversation with a bit of a zoomed out view and the macro outlook that we have. Over the weekend on Friday and then on Sunday, we had another banking failure in the United States. It's been stepped in. JP Morgan has stepped in and stymied the crisis, at least for now. But the worry is if there is going to be another shoe to drop. And plus, you've got the Fed, which is likely to continue with its rate hiking cycle, at least for one more, at least in the month of May right now. Your thoughts on how the macro is currently positioned, and is it favorable for the markets to continue doing well? The global
Sure. Good morning. Yeah, thank you. Good morning. After SVB and more recent developments, it's becoming quite clear. If you look at the month gone by, there's been a shift from long bond to long equity again of flows, etc. So I'm talking about the short-term flows are usually noise when it comes to long-term investing. But yes, we've in the last 1 month or so seen some shifts from bonds to equities. So there is a possibility that with the more recent events that you're talking about, this trend continues. If it does, then the growth-oriented stocks will obviously be the first ones to benefit, which is what we've been seeing in the last few weeks. But other than that, I think the big question then is, do we have global linkages? So there are certain sectors. So for instance, I would say commodity producers, for instance, as a sector. About a year ago, this sector was benefiting from the Russia-Ukraine supply chain disruptions and the commodity prices going up. And if now with the global macro situation evolving the way it is, if the demand environment becomes a lot more muted, then globally demand-oriented sectors, global demand-oriented sectors in India, they might see some pressure. So yeah, there is a possibility for some jaw opening, where global linkages to fundamentals might see an adverse effect, but at the same time, you might actually see some flow-related positivity to growth-oriented stocks.
Rakshit, hi. Good morning. Good to have you on the show. I'm just curious about one of the companies that I think you own, and that's Titan. It'll be reporting numbers today, and of course, we'll hear more from the company, from the management as well. But I'm just wondering, do you get concerned as an owner of the stock, given this huge rise in gold prices, which is still the bulk of Titan's business? Do you see that having some impact perhaps on discretionary demand? What are the triggers ahead for this one?
Not really. So what we've seen in the longer run is as long as the confidence in gold as an asset class in the minds of the jewelry consumers remains, and price hikes usually they reiterate that price increases in gold commodity, it reiterates that confidence in the minds of the jewelry buyers. As long as that remains, I don't see any meaningful adverse impact from gold prices on Titan's prospects. In the past as well, only during sudden, sharp, significant jumps in gold prices have we seen 1 or 2 quarters of slightly muted footfalls for jewelers like Tanishq. Otherwise, a gradual increase in prices, in fact, leads to increase in footfalls, typically because the perception in the mind of the buyer is that what you're buying today doesn't just have ornamental value. Given what has happened to prices more recently, it might actually also have investment value, etc. So that's how things have moved in the past. But Titan as a business, I think it's way beyond just gold prices. That's the main reason why we buy it. It's a disruptor. It's a great capital allocator. And it's gaining market share in gold and diamond jewelry by leaps and bounds from its competitors.
Okay, so that is on Titan. Rakshit, thanks for joining us. We were talking about the banks. A lot of the Indian banks, pretty much all of the large ones, have done really well, right, in terms of their earnings. I know last time we spoke about HDFC Bank, about Kotak. Is there anything else that you would look at right now in terms of an investment, any of the other banks, even if it's the mid-sized ones?
Yeah, no, in lenders in general, not just banks, even NBFCs, I would say there's a bit of a jaw opening that has been visible more recently, where particularly around deposit growth. In an environment where deposit growth for the industry is moderating a bit, quite naturally in a rising interest rate environment, that tends to happen. There's logic to it. You've got a few banks and NBFCs growing deposit base at a very healthy rate, right? So, for instance, in our portfolio, we've got a Bajaj Finance, an HDFC Bank, Kotak, and a few other lenders. ICICI Bank has grown deposits as well at a healthy pace. So these kinds of high quality deposit franchises in this sort of an environment will pull away from the rest, right? So that's one very big differentiator. And then, it's benign credit cost environment. So pretty much all the banks are benefiting from that. But I think the separation of men from the boys will start from the deposits and then go on to loan book and the credit costs as well in future in due course.
Rakshit, unfortunately, we're out of time. We've got a lot of boardroom conversations, planned. Thank you very much for joining in. Get into